our existing traditional financial system has done a terrible job of providing low cost, fast ability to move money. If I were to fly to London tomorrow and I needed to get $10,000 there, it'd be much quicker for me to stuff the cash in a suitcase than it would be to wire it to London.
Chris Giancarlo, former chairman of the CFTC, has been one of the most influential voices in shaping how regulators view cryptocurrencies. When he speaks about digital assets like XRP and XLM, he's not speculating on price. He's talking about the fundamentals that determine adoption, utility, and long-term relevance. This makes his commentary essential for anyone who wants to understand which factors truly drive the growth of XRP and XLM. Unlike casual opinions or social media hype, Giancarlo focuses on the infrastructure, regulatory clarity, and real-world integration that create sustainable demand. Giancarlo's background gives him a unique vantage point. As former chairman of the Commodity Futures Trading Commission, he oversaw digital asset markets, derivatives, and compliance frameworks. He knows firsthand how regulation, adoption, and institutional interest intersect, and why that intersection often shapes which cryptocurrencies succeed or fail. When Giancarlo discusses XRP and XLM, he's emphasizing utility, networks that solve real problems and integrate with financial institutions. These are the qualities that determine whether a digital asset becomes a functional part of the financial ecosystem, rather than remaining speculative or marginal. Both XRP and XLM have clear roles in financial infrastructure. XRP focuses on cross-border liquidity. It enables banks and payment providers to move money quickly and efficiently, without pre-funding accounts in destination currencies. Its on-demand liquidity, ODL protocol is already operational in multiple corridors, proving that it can reduce friction and costs in real-world payments. XLM emphasizes financial inclusion. Its network is optimized for low-cost transfers and partnerships with fintech companies, allowing underbanked populations to access financial services. XLM's design supports smaller transactions at scale, making it highly suitable for emerging markets. Giancarlo's commentary often highlights that these use cases are why adoption matters more than market hype. Digital assets that solve tangible problems are the ones institutions adopt. Giancarlo points to several fundamental factors that shape XRP and XLM adoption. Institutional integration: banks and payment providers are more likely to adopt digital assets that reduce operational costs, improve liquidity, and comply with regulatory standards. Regulatory clarity: clear rules allow institutions to confidently integrate digital assets without the risk of legal or compliance issues. Giancarlo has repeatedly emphasized that regulation isn't a barrier but a pathway to adoption. Financial infrastructure compatibility: XRP and XLM are designed to work alongside existing systems. This makes them practical solutions for real-world financial operations, not just theoretical experiments. Adoption in practical use cases: remittance, micropayments, and liquidity corridors are tangible examples where XRP and XLM demonstrate measurable utility. By understanding these drivers, holders and observers can evaluate adoption potential based on real metrics and developments, rather than speculation. Giancarlo's observations are especially relevant because the landscape is changing rapidly. More financial institutions are piloting blockchain solutions for payments. Emerging markets are increasingly adopting low-cost digital transfers. CBDC projects are testing interoperability, which aligns with the bridge functions of XRP and XLM. For investors or crypto enthusiasts, this is a signal to focus on real-world adoption trends. These trends indicate whether a network is growing in relevance and utility, which is a stronger measure of long-term potential than price movements alone. In the next section, we'll dive deeper into the specific adoption triggers Giancarlo highlights, the institutional integrations, corridor expansions, CBDC collaborations, and regulatory developments that drive real-world usage of XRP and XLM. We'll explore how each factor functions, why it matters for the networks, and what observers should track to understand the evolving role of XRP and XLM in financial infrastructure. This section isn't about speculation. It's about understanding the mechanisms that create sustainable adoption and utility, the things that Chris Giancarlo consistently points to as the real drivers behind digital asset growth. Chris Giancarlo has consistently emphasized that the growth and relevance of digital assets like XRP and XLM depend on real-world adoption. For him, adoption is not abstract, it's measurable, tangible, and tied to how these networks integrate with financial systems, institutions, and regulatory frameworks. Understanding these adoption catalysts is essential to see why XRP and XLM continue to attract attention from banks, fintechs, and payment providers. The first and most significant adoption catalyst is institutional integration. XRP and XLM are designed with financial institutions in mind. XRP's on-demand liquidity, ODL, allows banks and payment providers to move money across borders instantly, without pre-funding accounts in destination currencies. XLM enables efficient low-cost transfers, which is particularly valuable for smaller institutions and fintechs targeting underbanked populations. Giancarlo highlights that institutions adopt assets that reduce operational costs, increase efficiency, and comply with regulations. This adoption is measured by the number of live corridors, transaction volume, and integration with financial infrastructure. Each new adoption milestone is significant because it demonstrates functional utility. Unlike speculative interest, which fluctuates based on social sentiment, institutional adoption signals that the network is solving real problems for real users. Another major adoption driver is the expansion of payment corridors. XRP already operates in several high-volume corridors, enabling instant settlements between currencies such as USD, Euro, MXN, and PHP. XLM's low-cost transfer capabilities complement these efforts in smaller or underserved markets. Giancarlo emphasizes that the more financial corridors adopt a digital asset, the stronger its network effect becomes. Each new corridor adds liquidity, validates use cases, and encourages further adoption. This is particularly important in regions where traditional cross-border transfers are slow or expensive. By providing a practical solution, XRP and XLM are increasingly being recognized as infrastructure tools, not just speculative assets. Giancarlo consistently points out that regulatory clarity is a critical factor for adoption. Financial institutions require clear compliance frameworks before integrating digital assets into operations. XRP's compliance-focused approach and history of working with regulators make it attractive to banks. XLM's partnerships with regulated fintechs demonstrate a model for compliant adoption in underbanked regions. When regulators provide clear rules, institutions can confidently integrate these assets without legal risk. Giancarlo notes that this regulatory alignment is more powerful than any market hype, because it ensures that adoption is sustainable and long-term. Central bank digital currencies, CBDCs, are becoming increasingly relevant, and Giancarlo has emphasized interoperability as a key adoption factor. XRP and XLM are positioned to act as bridges between traditional fiat and digital currencies, allowing banks and governments to move liquidity efficiently. For example, XRP can facilitate cross-border liquidity between multiple CBDCs. XLM can support micropayments and financial inclusion initiatives in regions adopting digital currency frameworks. These integrations reinforce the real-world utility of the networks, showing that adoption is not theoretical but aligned with the evolving global financial infrastructure. Giancarlo often highlights the concept of adoption feedback loops. Each new institutional partnership, corridor expansion, or CBDC integration reinforces network utility. These feedback loops are crucial because they create self-reinforcing growth. Adoption begets adoption, and the networks gain practical relevance with every successful integration. For observers, tracking these loops provides actionable insight into adoption trends, which is far more meaningful than speculative price movements. Some recent adoption events illustrate these principles. Banks and payment providers expanding XRP ODL corridors in multiple regions. XLM-powered fintech platforms providing low-cost remittances in emerging markets. Pilot programs testing interoperability between fiat, tokenized assets, and digital currencies. Giancarlo emphasizes that these real-world applications are the signals that matter. Every new integration, pilot, or corridor expansion demonstrates utility, encourages trust, and strengthens the case for broader adoption. For XRP and XLM stakeholders, understanding these adoption triggers is critical. Giancarlo advises, Monitor institutional partnerships and corridor expansions. Track regulatory updates affecting compliance and adoption potential. Follow CBDC initiatives that integrate or test XRP/XLM networks. Watch for network effect growth, where adoption in one area reinforces further integration elsewhere. By focusing on these factors, observers gain insight into the evolving relevance of XRP and XLM beyond market sentiment or speculation. Adoption is the foundation of XRP and XLM's relevance. According to Chris Giancarlo, institutional integration, corridor expansion, regulatory clarity, and CBDC interoperability are the key catalysts. Adoption feedback loops amplify credibility and network strength. Real-world use cases, not hype or price movements, define long-term utility. In the next section, we'll examine technical and fundamental considerations, exploring how XRP and XLM's network structure, liquidity, and efficiency reinforce these adoption trends, giving them practical, measurable relevance in the financial ecosystem. XRP's design revolves around pre-mined supply and controlled liquidity. Ripple Labs manages large portions of XRP strategically, releasing tokens to support high-demand payment corridors. XRP in liquidity corridors. Every XRP used in a transaction or corridor reduces the available supply for other uses, creating a network where adoption directly influences utility. Strategic releases. Ripple can inject liquidity where it's needed most, ensuring that the network continues to function smoothly even as adoption grows. XLM has a different approach, with a supply designed to support micropayments and small transactions at scale. Its architecture prioritizes accessibility, low fees, and speed, which is essential for adoption in emerging markets. Giancarlo emphasizes that these structural mechanics make both networks functional, predictable, and attractive to institutions, rather than purely speculative. One of the strongest technical advantages of XRP and XLM is transaction finality in seconds. XRP can settle cross-border transfers in 3 to 5 seconds, compared to days in traditional banking systems. XLM enables fast, low-cost transfers suitable for remittances and small payments, especially in regions with limited banking infrastructure. Speed and efficiency matter because institutions adopt networks that improve operational performance. A system that saves time, reduces friction, and lowers costs is far more likely to see sustainable integration. Giancarlo highlights that long-term relevance is rooted in utility, not hype. Both XRP and XLM are built for practical use. XRP solves liquidity problems for banks and payment providers. XLM provides low-cost, scalable financial access in emerging markets. This fundamental focus makes their adoption measurable and predictable. Every new integration, corridor expansion, or fintech partnership demonstrates real-world value, reinforcing the network's credibility and long-term sustainability. Past adoption milestones show a clear pattern. Utility drives network expansion. New corridors and institutional integrations increase transaction volume. More volume attracts additional partners, reinforcing the network's utility. Regulatory alignment and technical reliability further accelerate adoption. Giancarlo often points to this cycle as proof that adoption is self-reinforcing. A digital asset with strong fundamentals and technical reliability grows organically as real-world partners integrate it into operations. Both networks are designed for interoperability with existing financial systems. XRP acts as a bridge between currencies in cross-border settlements. XLM supports integration with fintech platforms and tokenized assets for micropayments. This interoperability, combined with a history of regulatory engagement, makes XRP and XLM attractive to financial institutions seeking compliant, scalable solutions. Technical and fundamental strengths create feedback loops. Corridors expand. Transaction volume increases. Network utility grows. More institutions integrate. Adoption continues to scale. These loops reinforce the network's relevance and demonstrate why utility-driven adoption is more important than speculation. Network liquidity and controlled supply make operations predictable. Speed and efficiency enable practical integration. Fundamental utility ensures real-world adoption rather than hype. Historical adoption trends demonstrate self-reinforcing growth. Interoperability and regulatory credibility attract institutions. Together, these factors create a foundation for sustainable adoption, exactly the kind of real-world relevance that Chris Giancarlo highlights. As adoption grows, it's equally important to understand the risks and strategic considerations that come with integrating XRP and XLM into real-world financial systems. Chris Giancarlo consistently highlights that real-world adoption is meaningful only when supported by technical reliability, regulatory clarity, and strategic foresight. Regulation remains the most significant factor shaping adoption. Financial institutions cannot integrate digital assets without clear rules, and Giancarlo stresses that regulatory clarity is adoption's accelerator, not a barrier. Jurisdictional differences. Different countries have varied frameworks for digital assets, which can slow global adoption. Compliance costs. Institutions must ensure they meet AML/KYC and reporting standards before adopting networks like XRP or XLM. Strategically, stakeholders should track global regulatory developments, focusing on regions where adoption is most active. Regulatory clarity enhances confidence and encourages institutions to integrate XRP and XLM into core operations. Even technically robust networks face operational risks. Liquidity bottlenecks in certain corridors can reduce transaction efficiency. Integrating networks with local banking infrastructure may face technical or bureaucratic delays. Scaling for high-volume transactions requires continuous monitoring of network performance. These risks are not prohibitive but highlight the importance of tracking real-world performance metrics, adoption speed, and corridor growth to gauge sustainable network utility. XRP and XLM are not alone. Other blockchain networks and fintech solutions aim to solve similar problems. Alternative cross-border payment networks. New blockchain protocols for CBDC interoperability. Traditional banking upgrades reducing remittance friction. Giancarlo emphasizes that XRP and XLM maintain a competitive edge due to proven integration, regulatory alignment, and adoption in operational corridors, but observers should remain aware of the evolving competitive landscape. One of the most significant advantages of XRP and XLM is the self-reinforcing adoption loop. New corridors and partnerships, increased transaction volume, demonstrated utility, greater institutional trust, further adoption. This feedback loop is core to long-term relevance, showing that adoption strengthens itself over time. Giancarlo highlights that tracking these patterns provides more meaningful insight than any short-term market signal. Chris Giancarlo advises stakeholders to focus on measurable adoption indicators, rather than speculation. Monitor institutional integrations and new corridor expansions. Track CBDC pilots and cross-border partnerships that leverage XRP or XLM. Follow regulatory developments that clarify compliance standards. Observe network effect growth across corridors and fintech partnerships. By focusing on these adoption metrics, observers gain a strategic perspective on real-world relevance, rather than chasing price trends. Here's the key takeaway. XRP and XLM are not just tokens. They are practical solutions with real-world adoption, technical reliability, and institutional relevance. Chris Giancarlo's commentary makes one thing clear. The networks that solve real problems and integrate with regulated financial systems are the ones that endure. If you're following XRP or XLM, here's what you should do next. Watch adoption trends, not hype. Track corridor growth, fintech integrations, and institutional partnerships. Stay informed on regulations. Understanding compliance and legal frameworks gives you insight into adoption velocity. Observe technical reliability. Networks that scale efficiently and provide fast, low-cost transactions will drive meaningful integration. And here's where you come in. If this breakdown helped you see why XRP and XLM adoption matters, hit that like button, subscribe for more deep dives into crypto adoption, and turn on notifications so you never miss analysis grounded in real-world fundamentals, not hype. Drop a comment below. Which adoption milestone or partnership are you watching most closely? Let's start a discussion on what real adoption signals really look like. Remember, in crypto, knowledge is your edge. Understanding adoption, infrastructure, and institutional relevance gives you a clearer view of the networks that will actually shape the future of finance.